Have you ever wondered why your car insurance quote is higher than expected, leaving you feeling surprised and perhaps a little frustrated? Today we're diving into a key factor that often goes unnoticed: your credit score. In most states, it can directly impact your rates, potentially saving you hundreds or costing you more. Let's break down simply how your credit history plays a role in determining what you pay for car insurance and what you can do about it. Insurers don't use your exact FICO score, but rather a credit-based insurance score derived from your comprehensive credit history. This specialized score is used to predict your likelihood of filing claims based on statistical correlations between financial behavior and insurance risk. Key factors influencing this score include your payment history, the amount of outstanding debts you carry, and the length of your credit history. Essentially, it's an assessment of how responsibly you handle your money, which insurers believe correlates with your likelihood of making an insurance claim. Think of it like a report card for your financial responsibility, where a good score indicates you are a low-risk individual. Just as a careful driver is less likely to have accidents, someone with a strong financial history is statistically less likely to file insurance claims. For example, someone with excellent credit might pay 20 to 50% less for car insurance than someone with poor credit, even if their driving records are identical. Here's a quick demonstration. If your credit score drops due to late payments, your insurance premiums could rise by as much as 30%. Conversely, improving your credit over time by managing your finances responsibly can lead to significantly lower rates, proving it's not a fixed situation. A common misconception is that using credit scores for insurance is a form of discrimination or solely based on income. However, it's legal in 47 states and based on extensive data showing a correlation between credit behavior and the likelihood of filing claims. It's important to note that this practice doesn't apply in California, Hawaii, or Massachusetts, and other states like Maryland have limitations. Remember, your credit score is just one of many factors insurers consider, so always shop around for the best rates. To wrap up, yes, credit scores often affect car insurance rates by signaling risk, but it's a complex system with nuances. Monitor your credit regularly, pay your bills on time, and actively compare quotes from different providers to ensure you're getting the best deal. For personalized advice and to understand your specific situation, always check directly with your insurance provider. Thanks for watching, and remember to drive safe.